Welcome back, everybody. Now, originally this was going to be more of a normal earnings update video where I was going to talk about Starbucks, I was going to talk about Amazon and McDonald's as well, because they all reported earnings on the same day. But as I was digging into Starbucks, it was taking up a lot of my time and I have a lot to say about it. So I didn't really want to wait to put a video out there. And I'm going to try to get this one out on Thursday, so it'll be a day early, just because there were a lot of people in the comments who were asking me if they should buy the dip, if I'm buying more. And so I didn't really want to wait. So we're going to go with a little bit of a less polished video today. It's just kind of going to be me referencing my notes, and we'll just kind of chat about Starbucks. If you guys have read my newsletter before, you know that I really love movie references and TV shows. And if you watch this channel for a while, you may have caught on that I'm a pretty big Quentin Tarantino fan, as his movies have shown up on my shirts from time to time. Well, the best way that I can describe my feelings about Starbucks right now is with this Pulp Fiction clip.
The truth is, you're the weak, and I am the tyranny of evil men. But I'm trying real hard to be the shepherd.
Now, first off, if you haven't already watched Joseph Carlson's video about Starbucks earnings and their CEO interview, I highly recommend it. And I know most of you all watch his channel as well, and he does a really good job of breaking down why it was pretty terrible and his overall concerns. Now, in general, I try not to repeat what other people have been talking about in other videos, but there's definitely going to be some overlap just because we're talking about the same topic. All right, so what were their actual earnings? Now, if we look at global comparable store sales, they declined by 4%, driven by a 6% decline in comparable transactions, partially offset by a 2% increase in average ticket. And so the difference between those real quick is that the number of transactions is just how many people are buying, like how many transactions you made, and then average ticket was the average price of the transactions that were made. So when transactions go down but average ticket is up, it means that you're doing less transactions but you're charging people more, and they both kind of contribute to revenue. Hopefully that makes sense. And then if we look at North America, we see that they declined 3%, driven by a 7% decline in comp transactions, partially offset by a 4% increase in average ticket. International store sales declined 6%, with a 3% decline in both transactions and average ticket. And then China specifically declined by 11%, with an 8% decline in average ticket and a 4% decline in comparable transactions. And then if we scroll down to net revenues, we see that they declined 2%. And then the GAAP operating margin contracted 240 basis points. So basically their margin shrunk by 2.4%. And then their GAAP earnings per share declined 14% year over year, or if we want to use non-GAAP, that's fine. Non-GAAP earnings per share declined 8% year over year. And then lastly, Starbucks Rewards loyalty program averaged 32.8 million 90-day active members, which is up 6% year over year. But one of the things that was talked about in the Jim Cramer interview is that it was actually down from last quarter, which was over 34 million active users. So that definitely was a concern, because that was one where I went back and I couldn't find a quarter where they had declining rewards members since like 2020 during the COVID year. So that's a little bit concerning. Okay, so obviously having a lot of negative on the report and declining revenues and earnings per share is never something that's good, but why was the market reaction so strong? Well, for me, I really think it was due to four main reasons. One, the expectations were way off. Two, the explanations of why it was off were pretty weak. Three, the plan that was communicated to get better was relatively weak. And then four, the core strengths of the business look a little bit questionable now. So let's actually dive into each one though. And so first off, when we talk about the expectations and being way off, when you compared their actual results to their previous guidance, it wasn't even close. Because in January, they gave their full year guidance, and it was right here. They had global comp sales 4 to 6%, US 4 to 6%, China low single digits, and then when you look at global revenue, 7 to 10%, operating margin would expand, and then mainly full year earnings per share, they had an outlook of 15 to 20%. And when you compare this to what they actually did in the quarter, instead of having comparable sales growth, they had declines in all areas. And instead of having 7 to 10% of revenue growth, it was negative 2%. And then when you looked at earnings per share, instead of getting 15 to 20% growth, you get negative 8%. And then they actually updated their guidance for the rest of the year, which was even worse, because now comparable sales growth is going to be in the low single digit decline to flat, same with US, and then China is going to be single digit decline. The global revenue now is going to be in the single digits instead of 7 to 10%. And then probably most importantly, again, their full year earnings per share is going to go from 15 to 20% to now flat to low single digits. And so in one quarter, they went from being a company that said they're going to grow their revenue close to double digits and they're going to grow their earnings per share by mid double digits to basically being a company with declining revenues and 0% earnings per share growth. I mean, that is a catastrophic quarter, and it really kind of begs the question of what the heck is going on, especially when you consider the fact that there wasn't any black swan event that kind of caused it. One, because it completely changes the outlook for the company, and then two, because it's a completely different story for the future than we got from them just 3 months ago, which puts into question the competence or the transparency of the management team, and that was really bad. And then number two, the explanations that they gave of what happened were pretty weak. Now, had like a black swan event kind of happen, like maybe COVID in 2020, or even what they had last year where they had unexpected lockdowns in China at the end of 2022, then it can be kind of understood that, look, we had something big and unexpected happen. Here's how it impacted the numbers, and here's what we're going to do about it. This is exactly what Starbucks did last year that I thought was so great, because they stuck to their plan, they stuck to their guidance, and they just executed and hit their marks at the end of the year. But with this quarter, there was no concrete explanation as to what happened. Like, he said things like severe weather caused 3% of the issue, like severe weather. But then other than weather, he talked about this idea of the occasional customer. And he's kept on saying that the core customers are fine, they're still buying, but we need to aggressively pursue the occasional customer and communicate our value to them. Honestly, in my corporate career, when I would hear words like that, it was usually coming from some business consultant who was there to pitch and sell a strategy, to get a consultant fee, and really had no ownership of the actual business, right? These are words that they sound great, but it doesn't really get to the heart of the problem. Like, we can sit here and talk about, we need to aggressively pursue the occasional customer. Well, what does that even mean? Like, their sales are down, right? So it can be just the basic level. Are our prices too high, right? Is there increased competition that's eating away at a part of our customer base? Or, is this related to the boycotts? I didn't really talk about that, but people say that, they've been boycotted with the, conflict in the Middle East. So if those are things that are eating away at your sales, it makes perfect sense, right? Hey, your prices are too high. Maybe we need to ease back on the price increases and see if that helps increase transactions, right? Or, yeah, you know what? The competition is getting our, not so core customers. Now, if you came out and said, look, the occasional customer is not coming because now they're getting their coffee from McDonald's, that actually makes sense, right? Because then you can say, okay, well, McDonald's is cheaper, so maybe we'll cut back on prices, or, maybe we'll do something else. But he's not saying that. Or maybe he could say, look, we're really getting hit by these boycotts, and that's a temporary thing. They should go away over time, but it is kind of hurting our bottom line right now. And maybe he doesn't want to say that because he doesn't want to fuel the fire, give them the satisfaction or the motivation, knowing that it's hurting their business. I mean, maybe that's true, and we just don't know. But the bottom line is those three things make a hell of a lot more sense than saying we're going to aggressively pursue the occasional customer and communicate our value to them. Like, what does that even mean? Like, it's terrible. So anyway, all right. Number three, their plan of how they're going to get better is relatively weak. And here's where they talked about things like, we have demand that we're not hitting, because they're saying that there's a lot of people who add things to the cart in the app and then they don't actually buy. And they're assuming that it's because the lines are too long. They're not as efficient in getting it out. Honestly, I don't know how true that is. I mean, it's impossible to really know for sure. I think people just try to add things to cart just to try it out to see how much it costs. And then they kind of say, yeah, no, I don't want to do that. So is it efficiency or is it cost? I don't know. But the answer to how to solve that is two different things. And I think that's why it's important to kind of know the difference. And then he started talking about using the Toyota process improvement method or whatever. And again, in my corporate career, right, when you would hear leaders talk about this type of thing, it's not that there's not value in that. Obviously, there can be value in relooking at your processes and getting more efficient and boosting profitability. But again, if you had just missed by a couple percentage points here or there in your quarterly earnings, then this would make perfect sense, right? Hey, we just narrowly missed. We're going to get more efficient. We're going to get better. We're going to, cut the lines down and really get the throughput going. You missed by a mile in every measurable category that matters, right? That is not an efficiency thing. That is a different problem. That is a core business problem. It's not we're going to get 1% better today. Like that's not how you solve that. So that was one of the things that kind of really concerned me when I was listening to what they were saying the plan was. It was all these things that, sure, they sound pretty good, but not big enough to solve the issue that they're having or to rectify kind of how big the miss was for the quarter. Now, the one thing they did say that I thought was kind of interesting was being able to bring people in at different parts of the day. And they talked about being able to get a different slight like product mix or reward mix to get people in, in the afternoon times and the weekends. They're talking about extending hours, which again, I don't know how good of an idea that is or not, but at least it's something that's trying to drive up sales. At the end of the day, though, there wasn't enough about just core, how are we going to boost sales? And it was a lot about, we're going to improve processes. We're going to communicate our value better, like all this nonsense, this business consultant speak that I just don't really relate to very well. And then the last one is the core strengths of the business look a little bit questionable now. Now, the Starbucks brand is obviously still strong. They have a core customer base that is very loyal. I do think, in general, they still kind of have the affordable luxury thing that's going for them. However, as they've continued to increase prices, that means that it's a slightly less affordable luxury than it was in the past. And I think that could be a big reason why their percentage transactions have been dropping off. And so again, you talk about them having pricing power, which I think they do, but it might be reaching kind of a tipping point. And I know there was a couple of tweets about that as well. And it's just hard to tell because when you listen to the CEO talk, he didn't really talk about that at all. He talked about all these other reasons as to why things are down, as opposed to the fact that they may just have been too hard on their pricing and they need to dial it back a bit. So who knows? And now their rewards program has been an absolute strength, and the way that they can kind of bank dollars in that program, I think has really helped them. But again, this is the first quarterly decline that I found since COVID in terms of their reward members on a quarterly basis. Now it's still up year over year, and maybe it's just a blip, an anomaly, and nothing to worry about. But again, in the context of everything that you've seen this quarter, it's just another data point that is in the wrong direction. And then lastly, earnings per share growth. So going from 15 to 20% guidance for earnings per share growth to basically 0% in one earnings call is a little bit concerning, right? Especially when we just had an earnings call with them in January and there wasn't really any talk that, hey, the guidance was high or that they were seeing some weakness for the year. How does that happen in one quarter? I don't know. You guys know how I feel, obviously, about this. Let's kind of get to what am I going to do about this. Now, when I bought Starbucks initially, I rated them as good for business, okay for operational performance, and poor for valuation. And I even said at the time that they have these problems, but I can look past those if I believe in the core business strong enough. And I even did a whole video about Starbucks where they were the poster child for evaluating your stocks based on how they perform versus their own expectations instead of just reading the headlines. And when I look back at their 2023, that was one of the things that I really liked about the stock. Even though the stock price didn't do much, they performed extremely well last year in terms of meeting their own expectations, in spite of the fact that they had some obstacles with the unexpected lockdown in China. But the fact that they kept their guidance and they crushed it the rest of the year showed that they had a competence in leadership. It showed that they gave conservative enough estimates to give themselves some wiggle room to execute. And it shows that they were able to adjust after an unexpected obstacle and still perform well. And they stuck with their guidance, showing that they really understand their business and how they could perform. But then in one quarter, they go from a 15 to 20% earnings per share growth outlook to 0%. Like, how does that happen in one quarter without a black swan type of event? I don't understand that. And their plan going forward doesn't really seem to address the major issue, which is slowing sales. Plus, if we just look at some other numbers, they already were at a 13 debt to free cash flow number, which is high, and they raised debt again this quarter. So if I had to rate them again today, it would probably be okay for business, poor for operational performance, and okay for valuation, which just bottom line is not a company that I would invest in. So that's why when people ask me, am I buying the dip? Well, no, if that's how I'm rating them right now, I'm not adding to that position because that just doesn't look attractive to me. Because yes, the price now is in the 70s compared to when I bought like in the 90s or even in the 80s, but that's not the only thing that's changed, right? Like I think this idea that, oh, if you love Starbucks at 95, then you should love it at 73. But what we know about the business is different now than it was at 95, right? Like when Starbucks was at 95, they were a company with an earnings per share growth projection of 15 to 20% from the management team. Now they're a company with an earnings per share growth projection of 0% from the management team. So that's why it needs to be more than just about price. And people focus on price so much when really it's the underlying value. And so for Starbucks, I wouldn't be buying here mainly because there's a bunch of uncertainty for the future now, both with their actual results and with the competence of their leadership team, being that this type of surprise quarter can happen just kind of out of nowhere. But for me, I've obviously already invested in them, so should I hold my position or should I sell? That's really the main question. And when I was reevaluating my portfolio earlier in the year and I started making all those changes, I thought about cutting Starbucks at that time. Their growth really depended on China, which was a concern. Their sales and comp store sales growth had been slowing a little bit, and while they'd shown pricing power, the question was, can that continue or are they at a saturation point? Then you have these labor issues where it's this kind of weird thing where Starbucks is in the middle of both political ideologies right now where, on one side they're like, oh, Starbucks is woke, go broke. And then the other side's like, oh, everyone's joining unions and you're the big bad corporation and you need to pay us. So they're in this weird position where they're getting it from both sides. And if you watch my channel, you know that I don't do the political thing. I don't like politicians. And so anything that's overly politicized is not ideal when I'm looking for stocks. That's just how I do it. But I ended up not cutting Starbucks mainly because, one, they still projected to have 15 to 20% earnings per share growth for the year, and two, their management team was great at setting expectations and delivering last year, even through the obstacles in China, and then three, their rewards program continued to be one of the best, and then lastly, four, it seemed like they were working to improve those labor issues to make that a little bit better. And if you go down the list of the things that I monitor for the stock, which I've shared before, it's exactly all those things. But now if we review where they're at today, earnings per share growth outlook is 0%. The revenue outlook is negative. The management team competence is put into question. The rewards program had their first quarterly decline since COVID, and the labor issues seem to be progressing, which is good, but we don't know what that outcome is going to do to overall costs. And I mean, look, I've cut companies for way less than what's happened with Starbucks over the last 24 hours or so. And my confidence in them being able to turn it around based on what I've heard in the conference call and then also on the CNBC interview right now is very low. However, I do think that the initial reaction in the sell-off has been a bit overdone. So the first thing that I'm going to do is nothing. I'm going to kind of wait it out to see how this thing kind of all settles. But I'm definitely not going to be buying more. Like I said, how I would rate them now, it's not a company that I would buy into. But in terms of me holding, we'll see what happens over the next couple months, but there's definitely a chance that I'll be cutting Starbucks before their next earnings call. Because quite frankly, it's just hard to know how they expect sales to come back. Because they didn't talk about cutting prices. They didn't talk about if it was temporary with the boycott. And in my opinion, it's hard to be confident in what their plan is. And now people are going to say, oh, but it's a great brand, buy the dip and all that. They have a 0% earnings per share forecast for the year. And this is like I talked about with Hershey. This isn't a question of whether it's a good company or not a good company. It's a question of if the risk and uncertainty is worth your investment dollars compared to some other things that you could put them in. I've talked about this many times. Like I have no problem taking a loss on an investment. And right now, Starbucks is like 15 to 20% in the red for me. And the reasons why I was holding on to begin with have now changed. Their earnings per share outlook is different. The management team, which I thought was a strength, now is looking a little bit shaky. And so the question is, why would I still be holding? I mean, the only reason to hold now would be some kind of conviction of, be more convicted in your stock picks, or, I don't want to admit that I made a mistake the first time, or, I don't want people to say I'm day trading again. To me, none of those three reasons are a reason to continue putting your money into a company. And this is where I think these age-old investing quotes get a little bit misused, like hold for the long term through thick and thin. And that's not it at all. Like it's hold until the story that you bought into changes. And I think if you look at what I put as my Starbucks story and the things that I'm monitoring, I think it's pretty clear that those things have changed. And now the question is, have they changed for good? Or is this just a temporary blip that you're going to get by and it's going to be fine going forward? And for me, how you get the confidence in knowing which one it is comes from what the leadership team says and how much belief you have in their plan. And the problem for me is I don't have a lot of belief in their plan. But I do think that the market reaction is a little bit overdone. So I'm going to be patient and just kind of see what happens over the next couple months. And before the next earnings call, definitely I'll be making a decision on if I really trust that I want to stick with them through another earnings call, or if it's time to just move on, cut my losses, and go into something that I have more conviction in. So I'm not going to do anything yet, but I'm definitely not buying, and it's very likely that it gets cut before the next earnings call. That's just me. That doesn't mean that it's the right thing for you. You should obviously do things that make sense for your own goals and your own strategy. Of course, me saying that I'm going to probably cut it means that people will come in and say I'm changing too much again and do all that. It's fine. We all have to manage our portfolio and our stocks the way that makes sense for us. And it doesn't matter what anyone else thinks. So anyway, that's my thoughts on StarBucks. It was a very, very poor quarter, very poor earnings call, very poor plan, in my opinion. But I'm curious to hear what y'all thought about it. Maybe you thought it was a decent plan and maybe the reaction was overdone. But let me know down in the comments below. Now, if you want to see where my portfolio is at right now and the changes that I made over the past 4 months, then check out my last portfolio update, which I just released, and you can watch it by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.